A very good evening to all the participants of this webinar. We are starting with part 2 of inventories as part of our series of bookkeeping and accountancy. And we are doing valuation of inventory methods, and in that we are now at simple average price method. So we'll start with simple average price method. Now this simple price average method is used for computing the value of inventory, and it's a very simple method. All the different prices are added together and divided by the number of prices. So we are just taking the average of the prices. Then what we do is that the closing inventory is valued according to the price, according to the average price that we ascertain in this way. So we take all the item prices and we add them up and divide by the number of prices to get the average of the price. And then we use that price to value the quantity of the inventory that we have obtained by counting it. So this method is generally followed by those entities which are using periodic inventory method and not by those who are using perpetual inventory method, as it does not require any effort of identifying that closing inventory belongs to which consignment or which lot. So in fact, all the items are considered to be in the same lot. All the prices are averaged out, divided by dividing by the number of the prices, by the number of different prices. We would also like to say that this method is too simplistic and may not give a realistic picture. But let us look at an illustration. In the example of a manufacturer of radio sets, which we have seen earlier, let us calculate the value of closing inventory using the average price method. So since we are taking the example of the manufacturer of a radio sets, let us look at that example. So we'll go back to look at that example of the radio sets. Here it is. A manufacturer he purchases the condenser which he uses while manufacturing the radio set. And he has purchased the condenser on these dates. The quantity and the price is also mentioned. Now, as we are looking at this data, we know that total of 2,600 quantity or the units of the condenser have been purchased. This quantity is mentioned here, 2,600. And out of these 2,600, 1,600 units were issued during the month of December till 18th of December. So after 18th of December, we have purchased 19 on December 19 and December 28. And before December 19, he has purchased 9 plus 4, 13 plus 3, 1,600 units. So all the 1,600 units which he has purchased before December 18, he has already issued them for manufacturing. And thereafter on December 19, he has purchased 200 units. And on December 28 also he has purchased 800 units. So whatever he has purchased on December 19 and 28 is still lying in stock, and that has not been issued. Now, if we take the two prices, 60 and 47, and if you look at all the prices which are available, 50, 55, 55, 60, and 47. So we have these 5 prices here. Out of these 5 prices, the items belonging to these 3 prices have already been issued. So the items with these 2 prices are only the items which are not yet issued. So now let us see the simple average price method. We are taking the average of all the 5 prices. We are not restricting ourselves to 60 and 47 only. In fact, we are taking the average of all the prices that were available earlier and taking the average of that. Now, if we were to take the average of only those prices for which the material is available, then we would have used 60 and 47. But here, we are broad basing the price to take the average, and therefore we are using all the prices which were available or which were for which the products were purchased, or let's say the condensers were purchased, and dividing them with the number of the items of the prices. So we are getting 267 as the addition of 50, 55, 55, 60 and 47, and dividing that by 5 we get 53.4. So we are taking 53.4 as the average price, and we are going to value the 1000 units of condenser which we are having in our stock at the value of 53.4. So therefore, as you have noticed that 53,400 is the valuation. Now let us try to analyze the impact of the 3 methods, the Fifo, Lifo and the simple average price method, with the help of the following chart. We have taken one example, and with the help of that example, we have used all the 3 methods to find out the value of the closing stock. Now let us see and analyze the impact of the 3 methods with the help of the following chart. Now let us say that the units which were received on 10th of January, 500 units were received at rupees 50. On 15th of January, 500 units were received at rupees 60. And as far as units issued is concerned, on 20th of January, we are issuing 500 units. Now in this situation, what will happen is that if we were to follow the Fifo method, we have received 500 plus 500 units in purchase. That means we have received a total of 1000 units. The first 500 units we have received at 50 rupees. The next 500 units we have received at 60 rupees. And then we have issued, out of these 1000 units, we have issued 500 units. And therefore, we are left with 500 units. Now, if we were to use the Fifo method, the first in, first out method, we would assume that the 500 units that we have issued, they were the ones that we had purchased on 10th of January, because first in and first out. And therefore, the units that we are left with are those units which are valued at the latest cost, or the rupees 60 cost. So therefore, we'll value the inventory of 500 units at rupees 60, and we'll arrive at a inventory valuation of 30,000 rupees. On the other hand, if we were to use the Lifo method, in the Lifo method, we'll assume that the 500 units which we had received last, that is at 60 rupees rate on 15th January, they were issued on 20th January. So in that case, we'll value the remaining 500 units at the rate of rupees 50, because they are the ones who are remaining with us, and the ones which we had purchased for rupees 60 we have issued already. That is what we are assuming under the last in, first out method. So the valuation in this case comes to 25,000 rupees. And if we were to take the simple average method, then all that we have to do is that we add up 50 and 60 and divide by 2. So we get an average rate of, or an average price of 55. And if we value the remaining stock of 500 units at the rate of 55, we get a figure of 27,500. So in this particular example, although this example is not a very complex example, it is a simplistic example, but still we are getting some hang of what is happening here. In the Fifo method, we are getting an overvaluation. In the Lifo method, we are getting an undervaluation. But always it will not be an overvaluation or an undervaluation, because the prices can go up or prices can come down also. And the simple average method is giving a valuation which is in between the two. So simple average method also looks like as if it is a reasonable valuation method for inventory. So, but we need not conclude anything from here. All we can say is that the value of inventories changes based on the different cost formula that we have been using here. Let us compare the same thing over the previous example. If we take the previous example, we find that under the periodic inventory system, we are getting a value of 49,600. Under the perpetual inventory system, we are getting a value of 50,600. And here, under the Fifo system, we are getting a value of 49,600. So again, we can conclude that the inventory valuation depends upon the cost formula that is being utilized. Now let us look at another method, which is called the weighted average price method of inventory valuation. The simple average price does not consider the quantities which were purchased in various lots. So therefore, the weight of the lot quantities is not included in the formula for the simple average price method. So if we were to do that, if we were to include the weights of the various quantities purchased, it will be more logical to compute the weighted average price using the quantities purchased in every lot as weights. So the quantities will be used as weights, and the more the quantity, the more the weight of any purchase. So therefore, under the weighted average price method, the cost of the goods available for sale, or the cost of the goods available as inventory during the period, is aggregated and then divided by the number of units. The total cost is aggregated instead of aggregating the price. And while aggregating the cost of the goods sold, we are not aggregating just the cost of one item, but we are aggregating the cost of all the items which were available for sale at that time during the period of aggregation. And then that aggregate amount is divided by the number of units which were available for sale during that period. So therefore, the formula should be something like this. Weighted average price per unit should be equal to the total cost of the goods available for sale during that period divided by the total number of units available for sale during that period. So this available for sale words are important here. And once we get the weighted average price per unit, we can calculate the closing inventory by multiplying the weighted average price per unit with the number of units in the inventory. And we can calculate the cost of the goods sold by multiplying the number of units sold by the weighted average price per unit. So the weighted average price per unit is the price that is being used here to compute the value of the inventory. Now, to understand this calculation or this computation further, let us look at an illustration. Now we have a data given in illustration 1 and 2, and on that basis, taking the same example that we have been following earlier, we will now calculate the weighted average price, and we'll also calculate the value of the closing inventory by the weighted average price method. So here we are going to take the same example of the condensers that we have used earlier. So what is happening here is that on December 4, we have received 900 condensers at the rate of rupees 50 at the total value of 45,000 rupees. So we are taking receipts here, issues, and the inventory. Nothing was issued on this day, and therefore inventory is the same. Then on December 5, we are issuing 500 items, and the rate is same, 50 rupees, and the same amount. So that has been issued, and therefore if 500 have been issued, 400 are remaining, and 400 are shown in the balance here. Thereafter, on December 3rd, again we are receiving 400 units at the rate of 55, and nothing has been issued. So 400 is added to this 400, total is 800, and this rate was 555, and this rate was 55, earlier rate was 50. So we arrive at a average rate here, 52.5, and finally we get the amount here of the 800. Again, we receive on December 11th 300 items at this rate, and the rate is 55 again. And so this weighted average price is calculated here, 53.18. Now how this weighted average price is being calculated? We are taking the total sum of 20,000 and 22,000 and 16,500 and dividing by the total number of items, which are 1,100, and thereby we are getting a weighted average price. The weighted average price is therefore including the computation of the number of units also that are being purchased. So similarly, we are taking the weighted average price in this column here. The weighted average rate is being taken, and in that way the calculation keeps going on. We are going on receiving the inventory, then issuing the inventory, and finally let's say that we have issued the inventory here at 600 rupees. So this issue is at this average rate or the weighted rate 54.23. So this issue is taken at 54.23, and the remaining rate is 54.23 for 700 out of this 1300, because 600 have been issued. So as we keep on getting the receipts, we are going on calculating the weighted average, and finally on December 23, we have issued 500 items at this rate of 50.37, and we are left with this 1,000 items at the rate of 50.37. And since we are left with this 50.37, the valuation of the inventory that we are having with us is 50,377. So under the weighted average price method, the valuation is coming to 50,377, and whereas under the simple average method, the valuation was coming to 53,400. So not much difference here, but sometimes if the quantities are varying quite a lot, then there could be a lot of difference also. So that is the weighted average price method, by which we are calculating the weighted average price every time new items are being received. And we are going on calculating in every line with every date-wise calculations going on. Now both the methods, simple average method and the weighted average price method, are applied differently in case the entity uses the periodic inventory taking system or it uses the perpetual inventory taking system. So in case of periodic inventory taking system, inventory available for sale during the period is considered together and an average rate is computed. The inventory which is available for sale during the period is considered together, altogether, and an average rate is computed, and closing inventory is valued using that rate. Now, in case of the perpetual inventory, the records are maintained. In case perpetual inventory records are maintained, then average rate of the inventory is computed on each new purchase. Whenever a new purchase is made, we compute the average rate of the inventory as we have computed in the above table, and the next issue is recorded using the new average rate as it has been done in this table here. Illustration 4 above is showing an example of the weighted average method used in the perpetual inventory recording system. Now, in case, since this what we saw just now is the perpetual inventory recording system, because with every transaction, the weighted average rate is taken. Now, in case the entity would have been using the periodic inventory recording system, the closing inventory would have been valued in a slightly different manner. So then, on all those dates, whenever some quantity is being received, we will just calculate the weighted average price, taking into consideration all the rates, because what we are doing here is we're taking all the values like 1,33,100. We are taking all these values by multiplying each quantity with each rate. Like 900 into 50 is 45,000. 400 into 55 is 22,000. 300 into 55 is 16,500. Similarly, we are taking all the products and adding all the products up. When we add the products, we get 133,100, and we divide this with 2,600, and we get a weighted average price of we get a weighted average price of 51 rupees 19 paisa using the periodic inventory recording system. And then we value the closing stock of 1,000 pieces at this rate. So we get a valuation of 51,190. So what we have seen here is that if we use the weighted average method for taking the inventory valuation for the perpetual inventory recording system, we are getting a valuation of 50,377 for the 1,000 units in the inventory. But when we are using the weighted average method in the periodic inventory system, then we are getting a valuation of 51,190. So, which therefore means that the weighted average method, when used in case of the periodic inventory recording system, will give us a different valuation of the inventory when compared with weighted average method used in the perpetual inventory recording system. So in both the periodic inventory recording system and perpetual inventory recording system, the same method is giving a different valuation. Now we come to non-historical cost method. We have so far done historical cost methods, and among the non-historical cost methods, we'll now do the adjusted selling price method. Because among the non-historical cost methods, what we see is that the non-historical cost methods, they do not consider historical cost. Oh, we are not interested in history. No historical cost incurred to acquire the goods will be used here to compute the inventory valuation. So non-historical cost methods include, number one, the adjusted selling price method, and the second, the standard cost method. So let us first understand the adjusted selling price method. Now the adjusted selling price method is also called the retail inventory method. It is used because it is used widely in the retail business or in those businesses where the inventory comprises of items whose individual costs are readily ascertainable. We know that how much every item has cost in the retail business. The use of this method is appropriate for measuring inventories of large number of rapidly changing items, just like a retail shop. Items are coming in, items are selling out, and a large number of items are there, which are rapidly, inventories are rapidly changing. So, and all the items, most of the items have similar margins. Their margins are not varying much, and so for which it is impracticable to use other costing methods. We are not able to use other costing methods. Every item is different and it is rapidly being sold and purchased, and the margins are similar. Margins are similar means profit margins are similar. The cost of the inventory is therefore determined by reducing from the sales value of the inventory an appropriate percentage of gross margin. What we do is that we decide what is the sales price, and from the sale value of the inventory or the sale price of the inventory, we reduce the gross margin, which is the appropriate computed percentage. The percentage used takes into consideration the inventory which has been marked below its original selling price. There may be some inventory which has been marked below the original selling price because it is being attempted to be sold at a discount. So, depending upon the size of the inventory that is being undersold below the normal selling price, an appropriate percentage of gross margin is computed or estimated. An average percentage for each retail department is often used. Every retail department understands how much is the percentage of margin at which the items in that particular retail department or retail section can be sold at. So the calculation of the estimated gross margin of the profit may be made for individual items also or for the groups of items also. Sometimes profit margin is known for individual items, sometimes the profit margin is known for groups of items because for that entire group there is a almost constant profit margin, or profit margin can be calculated for every department also, as may be appropriate to the circumstances. If the entire department, a particular department has a gross margin which is similar, if all the items belonging to any department or items belonging to any group have a similar gross margin, well and good, we'll take that into consideration for the entire department as such. So here what is happening is that we are not bothering about the cost of the item when it was purchased. We are not bothered about historical cost. All we are bothered about is that we have to get the current inventory and we know the sale value. So we'll reduce from the sale value a gross margin either for that particular item or for the group to which that item belongs or to the department to which item belongs. Now let us take an illustration for the adjusted selling price method. Basically, we are adjusting the selling price by the gross margin to bring it to the cost price. Now let's take an example. Messrs. X, Y, and Z are doing retail business. Now some information has been obtained from their records for the year ended 31st March 2016. Now let's say that goods which were received from the suppliers, which is the purchase subject to trade discount and taxes, 15,75,500, and then there are some trade discounts 3% and sales tax for 11%, and there are packing and transportation charges also. All that is adding up to 87,500. And during the year, the sale is 22,45,500, and the sale price of the closing inventories, the sale price of the closing inventory is 2,35,000. So what we have to do is we have to find out the historical cost of the inventories using the adjusted selling price method. We are not going to use a historical method. We are going to use the non-historical method, which is the adjusted selling price method. So in the adjusted selling price method, what we are doing is that first of all, we take the goods received from the suppliers. Now, we have received the goods from the suppliers at this 15,75,500 rate, which was subject to trade discount. So we reduce the trade discount 3%. After the trade discount, we add the sales tax of 11%. As it was, the goods received were subject to trade discount and sales tax. We are reducing the trade discount given by the supplier, and then we are getting a figure of 15,28,235. And then on this, we are adding a sales tax of 11%, which is 1,68,106. And therefore, we are getting cost of 16,96,341. And we are adding packing and transportation charges to it of 87,500. And thereby, we are getting value of cost of purchases at 17,83,841. Now, on the other hand, sales during the year is 22 lakh, and closing inventory at the selling price is 2,35,000. So sales plus closing inventory gives us a value of 24,80,500. Now, from the sales plus closing inventory, we reduce the purchases, which is 17,83,000, which is coming from here, and thereby we get the gross profit at 6,96,659. From this gross profit, we are calculating a gross profit margin. The gross profit margin is coming to 28.09%. How it is coming to 28.09%? We are taking the gross profit of 6,96,659 divided by the total sales of 22,45,500, and thereby we are getting a value of 28.09% by multiplying by 100. So therefore, we get a gross profit margin. First, we compute the gross profit margin that we are getting here, and then from the selling price of the closing inventory, which is 2,35,000, we are reducing the gross profit margin. We are taking 28.09% of 235, which is the gross profit margin, which is equal to 66,012. And we reduce the gross profit margin from the sales price of the closing inventory to get the valuation of our inventory, which is there with us, which is equal to 1,68,908. So this is a method where gross profit margin has to be reduced from the selling price of the closing inventory. And historical costs are therefore not considered if we keep in mind the gross profit margin. If we know that what is our gross profit margin, we don't need to calculate the cost every time. Here in this case, of course, we are calculating the cost, but normally a businessman would know the gross profit margin either for that item or for the group of items or for the department, and he will simply apply that gross profit margin by reducing from the selling price of the inventory, and thereby he will get a inventory valuation. Now, let's take one more illustration, which is called illustration 6. We have got the following information, and from that information, we are supposed to calculate the historical cost of the inventory using adjusted selling price method. Please remember that whenever the question says to calculate the historical cost by adjusted selling price method, what they are meaning thereby is that the cost of the inventories is to be calculated by using a non-historical method. So the data that we are having with us is sales is 2 lakh, the cost of purchase is 2 lakh, the opening inventory was nil, the closing inventory at the selling price was 550,000. So here again we take the sales and then we add the closing inventory at the selling price. We add the two of them, and therefore we get the selling price of the goods which is available for sale, which was available for sale, and from there we are reducing the cost of the goods which were available for sale. The cost of the goods were 2 lakh. We are reducing the 2 lakh from 2,50,000. Thereby we are getting the gross profit, because gross profit is equal to the selling price minus, or the sales value minus the cost of the goods sold. So therefore this 50,000 rupees is the gross margin or the gross profit margin, and to calculate the percentage of the gross profit margin we divide this 50,000 with the 2,50,000, which is the selling price of the goods available for sale, because goods available for sale are the goods which have been sold as well as the goods which are in the inventory. So we divide 50,000, which is the gross profit, by the selling price of the goods available for sale, which is 2,50,000, and multiply by 100 to get a gross margin or a gross profit margin of 20%. And then we apply this 20% to the closing inventory, which is 50,000, because 50,000 is the closing inventory at selling price, and therefore the selling price of the closing inventory has to be reduced by 20% of 50,000, and 50,000 minus 20% of 50,000 is equal to 40,000. So this is the cost of the closing inventory. So that is how, in this example also, we are seeing how the adjusted selling price method is used to compute the closing stock inventory by reducing from the selling price the gross profit margin. And of course, among the non-historical methods, we have the standard cost method also. And this method is used when there is a frequent change in the price per unit of the goods, and goods are purchased frequently by the business. For example, crude oil. Crude oil prices are changing every now and then, almost on a daily basis. So based on the experience, a standard cost of the item is determined, and the same cost is applied. On the basis of the frequent changes in prices and the data which is available, we arrive at a standard cost, and then that inventory, whatever inventory we are having, is valued at that standard cost price. So now having completed inventory valuation, we now move on to inventory taking, because the process of inventory taking, how does it happen? Normally all the operations are suspended for 1 or 2 days during the financial year, and the physical inventory is taken for everything in the godown or the store periodically. And when the physical inventory is taken, all the operations are suspended of the business normally. For the year-end inventory valuation, the physical inventory taking is done during the last week of the financial year. The last week of the financial year is used to take physical inventory, or during the first week of the next financial year. If inventory taking is finished on 26th March and the accounting year is ending on 31st March, all the purchases and sales between 26th and 31st March are separately adjusted with that closing inventory. Later, a value is put on each item. The principle of cost or net realizable value, whichever is lower, is applied either for the inventory as a whole or by item or item by item also. We have to apply the principle of cost or not net realizable value. That is one thing. Another thing is that on whichever date we are completing the inventory, from that date onwards, the purchases and sales are adjusted. And if we are doing it the next year again, the purchases and sales after 31st March are also adjusted backwards. So normally the enterprises prefer to perform inventory taking on the closing day. However, sometimes inventory taking cannot be carried out on the closing day of the financial year. So it is carried out a few days later, or sometimes even a few days earlier than the closing day. And in such a case, the actual value of the inventory must be so adjusted as to relate it to the end of the year concerned. So we adjust the value obtained of the inventory to 31st March or to the end of the year date. And for doing so, it will be necessary to take into account the goods that have been purchased or sold, or sales returns and purchase returns, and during the period which was remaining before the financial year end, or which are expired after the financial year end, and those items which have either come in or those items which have gone out during the interval between the close of the year and the date of the actual inventory, and those items then will have to be adjusted in the inventory that has been taken. Further, the adjustment of all goods must be on the basis of cost. So adjustment, whatever is made for the purchase and sale, it must be made on the cost value. For example, supposing a firm closes its books of accounts on 31st December, but it carried out the inventory taking on 7th of January next year. And actually inventory was of the cost of 7,85,000 during the period January 1 to 7. The inventory came to 7,85,000 on 7th of January, but we know that between January 1 and 7, purchases were 1,53,000 and sales were 2,50,000. And the markup being 25% on cost. Markup means the attempted gross profit margin. So in such a case, how will we compute the inventory? So inventory that has been ascertained is 7,85,000 on January 7. From this inventory, we will reduce the purchases that were made between January 1 to 7, 1,53,000 here, and then we'll add the cost of the goods sold during the period. So as the goods sold are 2,50,000, we reduce that cost, we adjust that cost by this 25% markup price. So we take 100 upon 125, or 100 upon 100 plus 25 of 2,50,000. And therefore this is the cost of the goods which were sold during the period of January 1 to January 7. And the cost of these goods are then added. First we reduce the purchases, then add the cost of the goods sold, and finally we get this value of 8,32,000, which is the closing inventory as at the end of the financial year, or at the end of the year that is followed by the concern. Now we look at one more illustration 7, because illustration 7 will give us an idea of what is happening here. So we are given certain particulars of the inventory, purchases, manufacturing expenses, selling expenses, administrative expenses, financial charges, and sales. And at the time of valuing the inventory as on 31st March, a sum of 17,500 was written off on a particular item which was originally purchased for 50,000, and it was sold during the year for 45,000. Now, barring the transaction relating to this item, the gross profit earned during the year was 20% on sales. So we have to ascertain the value of the inventory as on 31st March 2007, as on 2017 31st March. So let us see. The inventory as on 31st March 2016 was 1,42,500. As you can see here, 1,42,500 was the inventory as on 1/4/2016. And it is being mentioned here that out of that inventory, there was when we were valuing the inventory as on 31st March, a sum of 17,500 was written off on a particular item which was originally purchased for 50,000 and was sold during the year for 45,000. So this item was 17,000 was written off. So therefore, we are reducing the value of 32,500 from this 142,500 here, because this amount is equal to 50,000 minus 17,500, because this inventory includes an item which was actually purchased for 50,000 rupees and a sum of 17,500 was written off from there. So 50,000 minus 17,500, that is 32,500 we are reducing from this inventory of 31st March 2016 to adjust for this particular inventory which was made on 31st March 2016. Then thereafter we add the purchases to the opening inventory and we add the manufacturing expenses. The manufacturing expenses are given here. After adding the manufacturing expenses, we are reducing the cost of goods sold. So cost of the goods sold is sales minus the sale of the abnormal item, which is 45,000, because this abnormal item is mentioned here as it was sold for 45,000. We are reducing, we're completely eliminating this abnormal item here, because it is better to first of all, completely take out the abnormal items. Otherwise, we won't be able to compute the value of the inventory properly. So therefore, the sale of abnormal item is reduced from this, coming to 12 lakh, and then gross profit margin of 20% is also reduced to get at the cost of the goods sold, which is 9,60,000. So we are reducing the cost of goods sold from the opening inventory plus the expenses or the direct expenses and the purchases. And finally, we are getting an inventory, closing stock inventory of 62,500. So a point to be noted here is that if there was some abnormal item in the inventory, that abnormal item has to be completely taken out from the books in order to compute the inventory value of the closing stock. And therefore, this abnormal item is being completely taken off from here, from the opening stock, as well as the sale of that item, sale value is also taken out from the calculation. And apart from that, in order to get the inventory valuation, we take the opening inventory, to that we add the purchases, to that we add the direct expenses, and then we reduce the cost of the goods sold. And when we reduce the cost of the goods sold, we get the closing inventory. Because the cost of the goods sold is calculated by reducing from the sales the gross profit margin, and therefore when we reduce from sales the gross profit margin, we get the cost of the goods sold, and then cost of the goods sold is reduced from the opening inventory plus purchases and manufacturing expenses. Thereby we get the value of closing inventory as 62,500. Now let us take another illustration, illustration 8. A trader prepared his accounts on 31st March each year. Now, due to some unavoidable reasons, no inventory taking was possible till 15th April. So he took the inventory on 15th April 2017. That is after a delay of 15 days. On which date the total cost of the goods in his godown came to 5 lakh rupees. Now, on 15th April, the cost of the goods in his godown is 5 lakh rupees. Now, the following facts were established between 31st March and 15th April. He made a sale of 4,10,000, including cash sale of 1 lakh between 31st March and 15th April. He made these purchases, including cash purchases. There was a sales return also, and the goods are sold by the trader at a profit of 20% on the sales. So we are required to ascertain the value of the inventory as on the 31st March 2017 in this case. Now, to do that, once again we take the inventory which we had made on 15th April 2017. That is, inventory is coming to 5 lakh rupees here, 15th April inventory taking, and then on this inventory we'll be adding the cost of the goods which were sold during the period between 31st March to 15th April, and cost of the goods sold is calculated by taking the sales. So sales is 4,10,000 minus 10,000, 4,10,000 . 4,10,000 minus 10,000. This minus 10,000 is coming from the sales return, because 10,000 is sales return, and therefore we are getting a sales of 4 lakh, and then we are reducing the gross profit margin 20% of the sale to get the cost of the goods sold, and therefore we are adding the cost of the goods sold to the value of the inventory that we have obtained for 15th April, and then we will reduce the purchases during this period. We are adding the cost of the goods sold and reducing the purchases. Purchases during this period is 50,340, as we can see over here, 50,340. Or in other words, what we can say is that we are the inventory that we got for 5 lakh rupees. Whatever purchases were made during this period has to be reduced, because those purchases are already coming, are part of this inventory, and therefore we'll have to reduce those purchases, and then we will have to add the sales during the period, or rather we'll have to add the cost of the goods sold during this period, which is coming to 3,20,000, and therefore we are getting the final inventory of 7,69,660. So therefore the formula, if at all it is necessary here, is to calculate the value of inventory in case the inventory is taken after the end of the year, is that we take the value of that inventory, then reduce the purchases and add the cost of the goods sold. Now, there are some more examples here which need to be done, but we have exceeded the time quite a bit. So what we can do now is that we'll have a session 3 for inventory, and in that session 3 we will try to make a complete revision, including the last 3 illustrations of this particular topic, so that this particular topic goes more deeply in our minds. So we'll do that tomorrow morning at 8 a.m. So please join us for Inventory and Valuation Part 3. And in that, we'll do a complete re-examination of this topic or revision of this topic, a quick revision of this topic, you can say, followed by the 3 illustrations that are remaining to be done here. And maybe we'll just add a few more illustrations and complete the 1 hour of revision of this particular chapter in part 3 of Inventory and Valuation tomorrow morning at 8 a.m. So please join us at 7:45 a.m. tomorrow morning for the next session on Inventory and Valuation part 3.